This is a video podcast we call the Tradeoff, and I'm here today with Nick Flanagan. Nick has done about everything in the mortgage business that you could possibly think of. He has been an underwriter. He's been a secondary marketing VP. He's been a CEO. He started, built, and sold a mortgage business from 2016 to 2020. He is now a branch manager for Summit Funding. Thank you for being with us, Nick.
Oh, thanks for having me. Thanks for the intro.
Absolutely. I was born in October of 1981. And the reason I bring that up is I was looking at the 30-year Treasury interest rate, the history of it. And it just so happens that that was the peak of the 30-year federal interest rate. It was about 15% that year. And of course, when people think about mortgages, probably the first thing they think about is interest rates.
Mm-hmm.
And the interest rates have dropped precipitously since then. I remember my dad telling me about his mortgage that was in the mid-teens. Completely impossible to imagine that these days, of course. And even going further back, I don't know if you've ever seen this, but the Bank of England, they did a study going back 5,000 years. I'll have to send it to you. I'll make it available in the notes.
Okay. But
from a 5,000-year interest rate perspective, the current rates are the lowest they've ever been, with the exception of, I think, a spell during World War II. They were down around 2%. But people might be wondering, with rates at around 2%, how do mortgage lenders make any money lending money out at 2.5%, 3% for a 30-year mortgage?
So, the way we really make a living, it's not on individual loans. It's not on individual fees. The way money's made in the mortgage business is really what we call pooling together MBSs. So we take one loan, two loans, 20 loans, etc., and pool them all up into a bundle at $5 million in mortgages at a time, and we sell them off as a security, as a mortgage-backed security pool. And the revenue from that is a larger scale. Even though the rates are at 2% and 3%, at $5 million in loans, it makes it a saleable item on the secondary market.
Thanks for explaining that. I think a lot of people don't understand that. That's really helpful. Something else that a concept I think is important, and I want to get your perspective on, is the Federal Reserve sets a base rate. That's the rate that we hear about that banks lend to each other with overnight money. Are there market conditions that realistically move, say, mortgage rates far away from those base rates, or are mortgage rates really tied at the hip to all those Federal Reserve interest rate movements?
It's pretty close. I love to use the analogy of a wholesale rate compared to a retail rate. So basically, if you go into the grocery store and you buy a can of beans, it's been marked up 10 cents or whatever. Now, there's 180,000 products, so they don't have to make a ton of money on every can of beans, right? You make a tiny bit on each one, hence the concept we just talked about. You put a bunch of loans into one pool at a small profit on each one, and it makes a larger profit to make it worth it. Mortgage rates in and of themselves, they can be moved quite a bit by any government reporting, the unemployment report, general statistics in the economy, etc. The key is they don't move that much, and I think there's a common misconception that a small change in interest rates makes a giant difference in the payment. So just as a very easy example, if you have a $100,000 mortgage, the difference in payment monthly between 2.875% interest rate and 3.0% interest rate is $7 a month. Now it sounds like, oh my gosh, that's so much money. It's the difference between the twos and the threes. It's really the same difference between buying a can of beans for 99 cents or a can of beans for $1. There's a perception that makes it very different.
I see.
So,
Let's talk about the state of the market. in the early month or two of the pandemic, all markets were disrupted. Understanding is that the mortgage market was disrupted. A lot of people trying to refinance all at once. The interest rates got a little wonky as a result. As we talk, it's late June 2020. Have the markets returned to normal such that most lending products are available and stable, or are there certain parts of the market that are kind of messed up?
Yes. So most lending products are now stabilized. Where you have the most volatility is at the top of the market and the bottom of the market. So what I mean by that is about 6 months ago, if you were a first-time home buyer and had some credit blemishes, we could do a loan for you with 3.5% down at a 580 or greater credit score. Now that 580 or greater credit score requires 10% down. Okay. On the other end of the market, in the super jumbo market, jumbo loans, meaning greater than $510,000, went away for about 45 days. They're now back, but they're also back with the normalized 20% down. So to answer your question in short form, there was a tightening of the market. It was very volatile for a couple of months. Interest rates went into the low or mid 2% range on a 30-year fixed for a short period of time. And now it's kind of normalizing back to where it should be, that we've been real safe in over the last 10 years.
I think it's generally confusing for people to try to distinguish between mortgage brokers and mortgage bankers.
Mm-hmm.
Can you help us distinguish and just understand the relative advantages of each?
You bet. So a mortgage broker is really a middleman, is the easiest way to think about it. A mortgage broker charges the client a fee to receive their documentation and kind of blast it out to 5 or 6 different banks and see what's the lowest rate or product you can get. The downside to that is they have really no control whatsoever on being able to close your loan, get it to the finish line on time. It's especially important in a purchase of a house, because if you miss the close of escrow date, you can lose your earnest money and even be sued. So that can be a little dangerous. A mortgage broker, that's the definition of that. A mortgage banker or a correspondent mortgage company means that we do everything internally. So we take the loan, we underwrite the loan, we fund the loan on our credit line, on our money. And after the closing, we take that loan, we pool it up with 20 or 50 other loans, and we sell it off to an end investor. So we don't have to charge anything to the client, because our service is valued in a pool of 20 or 50 loans at a time, rather than one client, one time, one fee per person.
That takes me to my next question, which is, how can the borrower try to make sense of how their broker or banker is compensated, such that if they're comparing two, how to make some sort of an apples to apples comparison, just to make sure that there's a reasonable fee being charged in either situation?
Sure. So a mortgage broker has to disclose to you how much they're being compensated from the lender they're sending your loan to in the end on your initial loan estimate. A mortgage banker or a mortgage company isn't charging you anything. So there's no disclosure, because there's nothing being charged to the buyer.
Thanks. I don't think that's well understood at all. I appreciate you explaining that.
Sure.
I want to ask you about a rule of thumb. So right now people are looking at their mortgages. Maybe they're at 4, maybe they're 4.25, maybe they're at 3.5. And they're thinking, holy cow, maybe I should look at refinancing. I never thought I'd say that. I thought I had the best rate of my life, but maybe I should refinance. Is there a decent rule of thumb where people should really take a hard look at it, whether it's 50 basis points difference and they're going to be in the house for 3 to 5 weeks, something like that?
Sure. So there's a couple of ways to look at that, and I'm going to give you the most bumper sticker version available. The first thing is there's 2 kinds of refinancing. There's what's called cost refinancing and no cost refinancing. Cost refinancing means you're paying closing costs, but you're getting the lowest interest rate possible. For example, if you're at 4.25% today on a 30-year fixed, and you have a cost refinance and there's $2,000 or $3,000 in closing costs, you can either roll those into the new loan, not come out of pocket with anything, and or pay them in cash and get an interest rate of 2.875 yesterday. The other option is you're at 4.25% and you don't go all the way down to 2.875. Say you take 3.125, but you pay no closing costs out of pocket and you roll nothing into your new loan. So literally, you're not getting the lowest rate possible, but it also didn't cost you any money to achieve the savings, okay? The general rule of thumb is this. If you're going to move or sell the house within 12 months, you should not refinance. It doesn't usually equate to the cost, or you should absolutely do a no-cost refi, because that way you're not increasing any of your debt load to save any money. Option B would be if you are in the high 3% range and you plan on staying in the home more than 2 years, it is definitely worth refinancing in today's market. And you're right. I never thought I would say that. I don't know how many times I've said 4%, 4.25%. These are great rates. That's cheap money. It's fantastic. We just never thought we would get here, and we're here. So while it's available, I definitely take advantage of it.
Another common decision point that people are up against is a 30-year fixed with the lowest possible rate, or maybe pay my house off a little quicker with a 15-year. And I know it's always situational, but do you have thoughts on how to help people evaluate that decision?
I really do. This is one of my favorites. So there's also a third option to that, which is in the middle, which is a 20-year. And I very commonly do a 20-year fixed for people, a lot of times with the reduction in interest rate, meaning if you were at 4.5% and you're going to 3% and you take a 20-year fixed, your payment can be exactly the same, yet you may cut 8 years off of your mortgage loan. If you can afford the 15-year, and one of my favorite ways to do it is look at, do you have any high interest rate debt, credit card debt, student loans, cars, anything like that? If you had $1,000 a month in payments, let's just say, on credit cards and cars, and a 30-year fixed mortgage currently, one of the things we love doing is take 10 grand in equity out of your house, pay off all the credit cards and the cars, keep your new monthly mortgage payment $200 higher than it was before, and convert to a 15-year fixed. So you end up with no interest, no high interest rate debt. You end up with a 15-year fixed mortgage, and you're paying out less money every month in your monthly budgeting than you were with the cars and the credit cards, and your house is paid off in half time.
That's a really fascinating strategy, and one that I can imagine myself describing to people in the coming weeks. Thanks for that.
Mm-hmm.
How about buying down the rate with points? Like we're talking about, how can the rates be any lower? But what are the conditions and when it typically makes sense, or you think it makes more sense to look at buying down a rate?
So I'll answer that in two ways. So the first way is your average mortgage over the last 10 years has been paid off every 38 months. So when you pay points to buy down a mortgage, and I'm going to explain what that means in a second in case anybody's curious, you have to really know you're going to keep this loan and this house for an extended period of time. For example, if you were borrowing $100,000 and today's interest rate was 2.875, and you wanted to get the interest rate of 2.5, you might have to pay 1 percentage point of the loan amount, meaning on $100,000, 1%, $1,000, to get the interest rate of 2.5%. That 2.5% might save you $20 a month. So without using a calculator, just on round math, you may have to keep that loan for 8 years to break even on your $1,000 upfront investment. Now, if you keep the loan for all 30 years, that was a great decision. If you're like most other people and you buy, sell, move, etc., within 3 to 4 years, you end up losing a little bit of money. So it's to each his own, but the answer to the question really lies in how long are you going to keep this loan? And if you can answer that, I can tell you what the right path is to take.
Last question, Nick. small business owners, independent contractors, people being paid 1099 with low or no W-2 wages have a hard time getting underwritten. What would you advise somebody in that situation to do to put themselves in a position where they could get better loan underwriting as quickly as possible?
So the best thing to do would be, let's start with a conversation and let's find out where you are. Have you filed your 2019 taxes? Have you filed 2018 and 17, et cetera, et cetera, et cetera? A lot of times it's about looking at where we are before deciding we can't get there. If there's pass-through income, Schedule C income, depreciation income, travel and expense income, mileage, all these kind of things we can add back into the borrower's income position to get them to qualify. It's often not as hard as it looks. The other option is a cosigner. We commonly put a cosigner on, which is of no risk to the buyer at all, and they can qualify pretty easy. So to answer you in short form, there's two ways. There are programs for people who claim no income, just on bank statements they can qualify. The interest rates are higher and they're not usually favorable terms. The other way is, it's really surprising. If you get somebody who really knows what they're doing and can look at a set of tax returns, oftentimes we can pull enough money out there to get to somebody to qualify.
Nick, you have a wealth of knowledge about mortgages. We really appreciate the education. What is the best way for people to find you if they have more questions?
Please contact me at 512-769-8807. Be happy to have a phone call with anybody who's interested. And, beyond that, I can be reached via email. It's kind of a long email. So just give me a call first and we'll be happy to go from there. And thank you so much for having me.
And Nick, your website one more time.
Sure. It's summitfunding.net, and my name is Nick Flanagan. So look forward to hearing from you. I'm in Austin and I'm local as well.
Thank you again, Nick.
Cheers. Take care.